Hey everyone, and welcome back to another video for today. So in today's video, let's touch on 3 stocks that are near their 52-week lows. Now, this is the picture of yesterday's market close at the time of making this video. Pre-market, the market is quite red. The markets in Europe are red as well. So there might be some opportunities today or maybe in the next couple of days. But in today's video, I'm already going to touch on 3 companies that are right now near their 52-week lows. And as always, I'm not here to waste your time, so they're going to pop up on the screen. Various companies in different industries. Hopefully you keep watching, and if not, leave a like and a comment, and especially subscribe. Would really appreciate that. And if you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. And also a special thanks to FinChat for supporting this channel. Now, first up, we have Pepsico. Pepsico is still at $132. It has a market cap of $181.3 billion. As you can see, over the past 3 years, we're still experiencing a drawdown from the peak of around 33%. Now, Pepsico, of course, pays a nice dividend, has a yield of around 4.1%. PE, currently trading PE 19.1 times, forward 16.2, and an average analyst price target of $150. Now, of course, this is not a fast growing company, right? We know Pepsi and even Coca-Cola, those aren't companies that are growing double digits anymore, right? Growth CAGR of the last 3 years, that was just 4.2%. And if you look at the, forward 2 years, that's 1.7%, and EPS is growing around the same rate. Now, of course, with PepsiCo, if you go for that types of companies, it's probably because you're a dividend investor, you're looking for value, you're looking for some cash flows, and that's definitely something that PepsiCo offers. Now, at the start of May, they had their annual general meeting. Of course, when you go on FinChat, you can read all of the transcript, whether it's earnings calls, AGMs, analyst conferences, and all of that. You can read through it, listen to it as well, or you can ask it to summarize. So, what did they tell us? So the key financial highlights here: 2% organic revenue growth for full year 2024, 9% growth in core constant currency earnings per share. Net revenue increased 37% over the past 5 years to nearly $92 billion. Core EPS increased 48% over the past 5 years. But remember, over the past 5 years, that means we go all the way back to 2020. These types of companies, while every other company had a huge boost, of course, in the pandemic. They expect to repay $4 billion of long-term debt in 2025. They plan to return approximately $8.6 billion to shareholders, including $1 billion through share repurchases. And so the key takeaways were here: resilience as a core theme. The CEO emphasized PepsiCo's resilience in navigating a challenging environment, highlighting the strength of its diversified portfolio and agile business model. Now, talking about the diversified portfolio, we can, of course, look at how they generate revenue, right? The different segments, all of that is available here on FinChat. You can go to segments and KPIs, and you see where they generate their revenue from. So, for example, we see here the split, right? PepsiCo Foods North America, we have Beverages North America as well. Then you've got the total revenue growth, which, as you can see, has been coming down. It's actually down 1.8% for the last quarter. So here you've got all of these segments, how much they've grown over the past couple of years, compounded or total change. We can also look at what the market is expecting this company to do with regards to free cash flow in the upcoming fiscal year. So in fiscal 25, free cash flow is actually expected to grow 33.4%, but then we see a big deceleration in growth, 11.1% year-over-year growth in fiscal 26, and then just 0.8% year-over-year growth in fiscal 2027. Of course, you can play around with all of this. This is available for you on FinChat. Link will be down in the description. New users will get 2 weeks of FinChat Pro for free. If you love it, you can get 15% off with the link down in the description and in the pinned comment. Continuing here, if we look at the PE, compare that to the 5-year average. Of course, we are much lower than where we were before, but that's also because we've had those, let's say 2 times where the PE was super high, and that brings the average quite high as well. But we're now under 20, so we don't really have to go back to the average here of 26. Can go back to closer to 24, 23 times, and that would mean that the stock would go a bit higher. Now, of course, previously the company was maybe growing a little bit more than what it is today. If we look at the forward PE, Here as well, it looks like it's extremely undervalued, which might be true. 16.5 times compared to an average of 22.7 times. So here as well, we don't have to go all the way back to 22. If we go back to 18 or 20, the stock will already react quite nicely. Now, what has happened with PepsiCo over the last couple of years? Well, gross profit margins has been flattish, right, over the last 10 years or so. Free cash flow margin, that's one that has actually been decreasing despite revenue going up. We see that free cash flow margin has been coming down. 10 years ago, we were at 12.9%. We're now sitting at 7.9%. Of course, one of the reasons this is happening is, well, the fact that they have been investing quite a lot. And so increasing CapEx is hitting here free cash flow margin. But once they're done with all of their investments and revenue can continue to grow and we can come back to, let's say, the 10%, 11% free cash flow margin, which I think is expected for this year. And if that's sustainable, I think that could be a good thing. Of course, increase in buybacks and dividends as well is going to be the results. Now, looking at operating margin over the last 20 years, well, okay, previously we were much higher, but the differences here are not that dramatic, right? You can see 18.8%, we're now at 15.6%, but back in 2022, we're at 14.2%. So we are seeing here a small recovery. Still have a long way to go to reach the 18.8%, but I don't think that's going to happen. So staying around 15-16% or so operating margin should be good enough. And that's the thing here with PepsiCo at the moment. Yes, it's true. It's not growing as fast as before, but you are still getting a nice dividend. You are still getting share buybacks as well. And so I think it is a safe bet at these prices. Moving on to DigitalOcean, ticker symbol DOCN. Now, this company is an interesting one, right? Of course, right now, when you look at this, the 5-year, the drawdown there, close to 80%. Over the last 3 years, we're closer to 45%. And over the last year, we're also down from the peak, 40%. This is a company that's worth $2.57 billion. What do? They operate a cloud computing platform in North America, Europe, Asia, and internationally. Its platform provides on-demand infrastructure and platform tools for developers, startup, and small and medium-sized businesses. So you would assume that right now this company should be making quite a lot of money. Well, let's talk about that. Right now, PE trailing 25.4, forward 15.4. Has an average analyst price target of $38 when right now the stock is trading at around $28. Looking at revenue over the past 3 years, that has grown at a compound annual growth rate of 20.4%. It's expected to grow much slower in the future, 13.5% 2 years out, and EPS just 2.5%. Here as well, we can go back, look at the transcript, AI summary on FinChat, and see the following thing. So revenue growth last quarter accelerated to 14% year over year. AI ARR grew over 160% year over year. Net dollar retention improved to 100% for the first time since Q2 2023. Revenue from customer with over 100,000 annual run rate grew 41% year over year, representing 23% of total revenue. Gross margin improved 61%, up 200 basis points year over year, and adjusted EBITDA margin was 41%. This year's strategic shift towards larger deals, which is always great to hear. AI inferencing dominance, which we've been hearing a lot more recently across the board in this AI market or even semiconductor industry. And so this is what the market is expecting DigitalOcean to report over the next couple of fiscal years. So revenue, as we've seen, around 13.5% CAGR over the next couple of fiscal years. Free cash flow for fiscal 25 is expected to increase by 44.1%, then just 10.2% in fiscal 26, and then another solid reacceleration here, close to 30% year-over-year growth in fiscal 27. As you can see right here, they had, of course, a period where this company was growing quite quickly, over 30%, and then growth started to decelerate quite rapidly, but it does seem like we have hit a bottom in the September quarter of 2024. I'm taking here the last 12 months so we get a better picture, and we can see that in the last couple of quarters, revenue started to re-accelerate. Now, looking at margins over the last couple of years, yes, we were a bit higher at 63.2% gross profit margin. Now it seems like we are back at around 60%, which is not far from where we were basically 4 years ago. Free cash flow margin was also peaking here around 18.3%, but as you can see, CapEx started to increase, and so free cash flow margin has been coming down. Now, as we know, CapEx is impacting free cash flow, and so once that CapEx expansion, let's say, period is over, we should be seeing free cash flow margin rebound towards that 15-16%. Looking at forward PE, of course, during 2021, everything was super overvalued, barely profitable and all of that. So you've got that huge increase, which impact here the average forward PE sits here at 52.7 times. We're now at 15 times. So here again, I take the same logic as before. We don't have to go back to the average. We can go back to 20, 24 times, and that should impact the stock quite positively. Same with price to free cash flow. Previously, of course, if there is no free cash flow or very little free cash flow and the stock is super overvalued, then you get this right here. So the average 34.5 times, we're not sitting at 14.4 times, but even under the average, right? We were at 20, 22, 23 times. Even if we go to 18 times, I think that should be good enough, depending, of course, on how fast this company is really growing. And the last thing here is operating margin. And as you can see, operating margin has been consistently increasing. Of course, we had that dip right here, Q2 24 to Q3 24. But since then, we have been making our way back up to now 15.2% operating margin over the last 12 months. So this is definitely a good trend. And now lastly, last stock here is of course Marvell Technology. Now Marvell Technology did of course rebound from the low $50 that it was a couple of weeks ago. So yeah, we are still near the 52-week low. We are also still experiencing a drawdown of around 46% or so over the past 5 years, but that's the same over the last 3 years because this stock did peak at the end of 2024. Year to date, for example, the stock is still down around 40%. Market cap of $60 billion at the time of making this video. PE trailing is of course negative PE right now. Forward one sits at 23 times. So that's the big difference here. The average analyst price target sits closer to $90. We're now at $69, $67, depending on when you're watching this video. Over the past 3 years, revenue has only grown by 8.6%, but that's expected to, accelerate quite a lot, right? Revenue forward 2 years, 30.4%. EPS is expected to grow by 50.9%. So definitely, as you will see, this also goes in cycles, as I'll show you in a bit. And yes, more recently, there was an analyst conference. And of course, we can just look at the highlights here. So Marvell guided the strongest quarter in the history of the company, guiding for $2 billion. Data center business has been growing annually at a 70% plus clip. The core business, carrier infrastructure and enterprise networking has rebounded to a 1.3-1.4 quarterly run rate, up from a low $900 million. And Marvell is now at a $8 billion annualized run rate. And so if we look at what the market is expecting this company to do, of course, we've seen what they expect revenue to be at for the next couple of years. What about free cash flow? Well, free cash flow for fiscal 26, that should grow 42.5% year over year, then 41.1%. And then in fiscal 28, that's decelerating quite rapidly, only 13.8% year over year growth. If we look at how they generate revenue, here you can actually see data center revenue as previously as a big cycle, right? We peaked back here, April 2022, then it went all the way down to the lows here in April 2023, and now we're making our way back up. And as you can see right now, data center revenue as a percent of overall revenue is of course much, much bigger than before. Actually, if we look since the May quarter of 2020, data center increased 40% CAGR, enterprise networking only 2.3%, carrier infrastructure 2.4%, consumer revenue is actually down 12.1%, automotive has grown at a compound annual growth rate of 12.1% since that quarter. Then looking at margins, gross profit margins over the last 10 years, yes, it has gone up, it has gone down as well, but free cash flow margin has actually improved a little bit despite CapEx increasing. That's pretty good. Now, looking at operating margin for this business, Again, now that data center makes up the majority of the revenue, of course, it's a completely different company today than it was 5-10 years ago. But here you can clearly see cycles, right? We go up, then we go down, we go back up, we go back down. Now we're making our way back up. So yes, there are some cycles even with companies like Marvell. Of course, now that we are in this AI cycle, you're also heavily competing with the likes of Broadcom, with the likes of Nvidia. I mean, it is definitely a positive trend at the moment for a company like Marvell, but they have to execute and deliver. Currently, over the last couple of quarters, they have been hit a little bit. There were some reports and rumors that they are losing a big client. Could be Amazon going to Broadcom, and that was the big hit that Marvell took. But all in all, since the stock is down, since they're seeing some solid momentum, I think it was worth talking about. And so all in all, that's about it for me in this video. If you have any stocks that are near their 52-week lows, do let me know down in the comment section below. Like, subscribe, do all of that, and I see you all in the next one.